Okay, everyone. So last week I traded three currency pairs: the pound against the US dollar, the Canadian dollar against the Japanese yen, and I sold the Great British Pound against the Canadian dollar. I hit three winning trades. Okay, you can see I made £24,000 profit from these trades, and this is a real account, not a demo account, so you can see these real results. Some of my members made incredible results, which I'm going to show you in my private Telegram groups. Okay. And they smashed it following these exact same trades. Okay, so if I show you over here, you can see some members taking the same trades, this member made £1,200 profit. One of my VIP members, this member over here, made £533 profit. Okay, other members again took the same trades, this member made £7,300 profit. Okay, following a gold trade. All right, so members have been absolutely smashing it, doing really well. I mean, there's so many results for me to show you guys. Again, this member taking a pound USD trade, £473 profit. So in this video, I'm going to educate you guys on these three trades. I'm going to explain the bond market, interest rates, why the dollar's so strong, why oil prices is causing the Canadian dollar to go up in value. So this will really help you guys understand like what causes currencies to go up or down in value, because we hit three winning trades in a row. And it's not just about me showing you these results, it's about me showing you exactly why the markets moved the way they did. So I recorded this full video for you guys, so enjoy it. Please like, comment, and subscribe, and come and join my private trading team on a 30-day free trial. I have thousands of members, and you should be in there. Okay, guys, enjoy the video. All right, so our live webinar is starting. All right, guys, so I'm going to break down the last three winning trades that we've had since we started this new challenge, £300 to £3,000. So I really want to educate you guys on what's going on right now in these trades to help you guys understand exactly why we're taking these positions. All right, guys, so we've said three trades. We've sold the Great British Pound against the US dollar, which is a Forex trade. We sold the Great British Pound against the Canadian dollar, which is another Forex trade that we won. And we're in currently another trade, the Canadian dollar against the Japanese yen, and we're also making money, and we're in a profit for this trade. So it's really important for you guys to understand why we're in these trades and what's happening. So I'm gonna go through some spreadsheets with you guys, break down the US economy, the UK economy, the Canadian economy, the Japanese economy, so you guys can really understand how I saw these trades and exactly why I sold and bought these currency pairs. Okay, guys? So let's start off with the trade, the Great British Pound against the US dollar. All right, so at this moment in time, you can see that the dollar is getting very strong against the British Pound. The pound had been going up in value against the dollar previously since around September last year. There was a good appreciation in the pound, but recently we've seen a very strong US dollar, and we took this trade about a week ago, and the trade has now gone into a really good profit. We closed it. The members made some amazing results. I'm going to share with you their results. But firstly, let's explain what exactly happened with this trade. So what has caused the US dollar to get so strong? And it's all because the Federal Reserve last week at that interest rate decision meeting said to the markets, they're going to keep interest rates higher for longer to get inflation back down to their 2% target. Okay, so what we need to do is look at the US economy and understand what's happening. In the US right now, inflation is at 3.7%. When you include food and energy prices, when you exclude food and energy prices, inflation is at 4.3%. That is above the central bank's 2% target. So the US central bank has kept raising interest rates since March 2022 to try to get inflation down, and it's working. You can see inflation's gone from 6.5% down to 3.7% and 5.7% down to 4.3%. Okay, but the reason why the dollar is so strong, okay, is because the US economy just remains extremely strong, okay? And you can see this in their forecasts. So the Federal Reserve has had forecasts that they're releasing to the markets explaining where they project their economy to go, and it's better than Europe, it's better than the UK, it's better than Japan. It's very, very strong economic growth in the US. So in this spreadsheet, what we do is we have to track the economy and how the US economy is performing to understand what's going to happen with interest rates. And interest rates is the number one reason why a currency goes up or down in value, which I'll explain in more detail. Okay, so just so you can understand what's happening in the United States, the latest forecasts by the US Central Bank signaled that the economy is going to grow this year, okay, by 2.1%. At their last projections back in June, they was only expecting the economy to grow at 1%. So they basically doubled their projection for growth in the US, which is good, but not that good for inflation coming down, okay? Next year, they're expecting the growth to be 1.5%. Previously, they was expecting 1.1%. In 2025, 1.8%. Okay, and in 2026, 1.8%. So growth in the US is now stronger than the Federal Reserve predicted. Okay, that is a very positive sign for the US economy in terms of growth, but it's not good for inflation. So what the central bank is saying, the US economy is so strong that it's not going to slow down quick enough to get inflation back down to their 2% target. So the Federal Reserve is telling the markets, we're going to keep interest rates higher for longer. Okay. Now, in contrast to the United Kingdom, the UK economy, the Bank of England's forecast is for growth to be 0% in 2023, when it was previously 1.2%, and next year only 0.2%, when it was previously predicted to be 1%. So UK economic growth is a lot weaker than US growth, okay? So when investors are looking at whether they want to put their money in the UK or the United States, they're looking at the US having stronger growth than the United Kingdom and, more importantly, higher interest rates, okay? So let's look at government bonds, which is very important. I want to explain how government bonds drive the currency markets. This is what we call the interest rate if you borrow money to the US government. So you can see recently, the US 10-year government bond interest rate has been going up. And you can see, look, since May, it's been going from 3.38%, which you can see on the right-hand side here. It's gone all the way up to paying 4.5%. You've seen this big rally higher in US interest rates, okay? Now look what's happened in the pound against the US dollar. Can you see on the left-hand side, you can see the pound has been getting weaker against the dollar as these interest rates in the US have been going up. So you can see that correlation between the two. When interest rates in the US went up, the pound against the dollar went down, okay? So what investors are looking at, they can look at the United States and see they can get 4.5% interest paid on US government bonds. And if they borrow money to the UK government, they can get 4.35% interest, okay? So what that means is you're going to get higher interest rates in the US for 10-year government bonds, okay? But most importantly, the central bank interest rate in the UK is higher than the United States. And now this is the key, okay? Look, interest rates in the US are 5.5%. Interest rates in the UK are 5 to 5.25%. So we got higher rates in the UK, in the US, but look what the markets are predicting. The markets are predicting pretty much no interest rate cuts until maybe September next year is the first time the US Central Bank may cut interest rates. But the markets are predicting the Bank of England is going to cut interest rates from 5% down to 4.5% by around the same time next year. So what that basically means is the UK Central Bank will cut interest rates quicker than the US Central Bank. And that makes sense because we've looked at the spreadsheets, which shows us that UK growth is expected to be weaker than US growth. So next year, look, we can see US growth will be 1.5%. UK growth will only be 0.2%. So I can show you throughout history, if we look at this spreadsheet over here, how the difference in government bond interest rates drives the currency market. So here we have the UK 10-year government bond. What is the interest rate paid if you borrow money to the UK government for 10 years compared to the United States? The difference is in column B, and column B is the blue line, and the orange line is the exchange rate. Now, if the US pays a higher interest rate than the United Kingdom, then anything above zero means that the US pays a higher rate. Anything below zero means the UK pays a higher rate. And look at the exchange rate. It follows the difference. So here you can see between 2014 and 2017, the UK interest rate was going higher and higher relative to the US, or the US interest rate was no longer paying a higher interest rate. The UK was no longer paying a higher interest rate compared to the US. And this is what drove the pound against the dollar lower in the currency markets. You can see as the blue line goes down, showing the UK interest rate is either higher than the US, or the US interest rate is no longer paying as much interest over the UK. The exchange rate goes down. And then as soon as the difference goes in the
the dollar's favor, where it goes higher from, let's say the pound was paying 1.5% interest higher over the US, and then it goes all the way up to only now paying 0. And now the US is paying a premium of 0.5%. You can see the exchange rate rallies at exactly the same time. So this bond market is very key to the currency markets. And because US bonds keep going higher, the interest rate on bonds is causing a strong US dollar. And because also when the Bank of England had their interest rate decision last week, okay, we can see that that markets don't like the fact that the UK economy is going to get very, very weak. So we can have a look over here. Traders fret Bank of England pause will hurt the pound as inflation is still a threat. So because the Bank of England has signaled at the latest interest rate decision meeting that they're not going to raise interest rates anymore, they're going to wait and see. But UK inflation, if you have a look, guys, UK inflation in the United Kingdom is a lot higher than the United States. So you can see in the UK, 7% compared to inflation in the US only being 3.7%, okay? There's a big difference between the two. So investors would rather invest in the United States and get an interest rate on a 10-year government bond, okay, of, if you have a look over here, 4.5%. And when you strip out where inflation is expected to be in the United States, look, we can take the 10-year interest rate in the United States and we can adjust it for where inflation is predicted to be, which is over here. The expectation for inflation, is only 2.3% over the next 10 years. So that means that you get a real interest rate of 2% in the US, but look at the UK. The real interest rate is only 0.75% because inflation in the UK is predicted to be 4% over the next 10 years. So even though the US and the UK have a similar interest rate of around 4.5%, the prediction for UK inflation compared to US inflation is a lot higher in the UK. So investors would rather buy US government bonds and get more interest over inflation compared to UK government bonds, which is not going to protect investors from UK's higher inflation. That is fundamentally why we took this trade and we sold this currency pair, because even though the interest rates are similar, the US inflation is lower and it's expected to come lower as well. Okay, because if we look over here on our spreadsheet, we can see US inflation, again, is predicted to only be 2% over the next 10 years, while UK inflation is going to be 4% basically. So you can see the correlation between, if you're an investor and you want to park your money in government bonds, you don't want to buy stocks, you don't want to buy crypto, you don't want to buy oil, gold, you just want to park your money in a government bond. It's a safe place to park your money. You want to buy a bond which is going to pay the highest amount of interest over the expected rate of inflation. And at this moment in time, the UK inflation is much worse than the US. So investors are rather parking the money in the United States relative to the UK. That's why we took that trade, pound against the US dollar, okay? That's the fundamental reason we got in that trade and we made a profit, okay? Another winning trade I took with the members was this trade here, the British pound against the Canadian dollar. So again, because of this situation in the UK with high inflation and the government bonds not protecting inflation from investors, and we had oil prices recently going up. I don't know if you've seen in the headlines, oil prices have shot up nearly $100 a barrel. This is very important to Canada because Canada's key export is oil. So what we can do is we can go over here, go to the OEC website, and we can type in Canada, and we can see, whoops, sorry, wrong one. Let's go back over here and type in Canada. We can see that Canada's key export is crude oil, okay? So look, 16% of their exports is crude oil. Petroleum gas is around 3.1%. And then we got refined petroleum around 2.3%. So around 20% of Canada's export is crude oil. So now I'm going to show you just how important crude oil is to the performance of the Canadian dollar. So over here, I have a really good spreadsheet, which I'm going to show you. And you can literally track throughout time just how important commodities are to the Canadian dollar. So here is the US dollar versus the Canadian dollar and oil prices. But as soon as you understand oil prices and the Canadian dollar, you'll understand why the Canadian dollar has been getting stronger as oil prices go higher. Here is the price of oil on the left-hand side, okay? The blue line is the Brent crude price going back from 2001 to 2023. On the left-hand side, this is the price of oil the price of a barrel of oil in dollars. So you can see in 2001, the price of oil was $20 a barrel, okay? And then you can see that between 2001 and 2008, oil prices went from $20 a barrel up to $140 a barrel. For the whole 7 years, oil was going higher and higher and higher. And you had the US dollar against the Canadian dollar in the orange line, okay, and the exchange rates on the left-hand side. Look how strong the Canadian dollar got against the US dollar during that whole period of time. Now, why would that happen? Well, obviously, as oil prices go higher, when international buyers want to buy Canadian crude oil, they have to sell their currency, buy Canadian dollars to buy crude oil from Canada. So as the oil price goes up, it just means the currency of Canada is in higher demand to export the oil to international buyers. And that's why the Canadian dollar was getting stronger and stronger against the US dollar the whole time oil prices were going up. And then look what happened when oil prices plummeted in 2007 because of the financial crash. Oil prices plummeted. Then what happened? The dollar got stronger against the Canadian dollar because now less Canadian dollars are being purchased to buy oil as the oil prices drop. And then as soon as the oil prices go higher again, the Canadian dollar strengthens against the US dollar. Okay. And then we have a period here where the oil price goes down again. No surprise. The US dollar goes up in value against the Canadian dollar. And then we have a period here where oil prices pretty much are flat over this period of time. No surprise. The US dollar, Canadian dollar exchange rate is flat until what happened? Oil prices went up again. The Canadian dollar strengthened again. So you can see this correlation between higher oil prices, higher currency, lower oil prices, a weaker currency. So this explains why I took the trade with the members and we made a really good profit for the pound against the Canadian dollar for that exact reason. When I was looking at the markets and I was seeing a strong oil price, I knew straight away the Canadian dollar is going to get stronger. And you can see here, look, as soon as the oil price went higher on around the 25th of August, no surprise, that's when the Canadian dollar started to strengthen against the British pound, okay, as an example. And that's why I sold this currency pair and made a really good profit. Okay, you can see how much it's gone down since we bought around this price. Okay, so that explains why we took this trade. And now we're in another trade, which we're still holding, which again is in a profit. And that is the Canadian dollar against the Japanese yen. We bought here, we're in a profit right now for the exact same reason. Oil prices are going up, but not just oil prices going up. In Japan, okay, the yen sinks to a 10-month low after the Bank of Japan stresses need to keep policy easy. And that basically means if you look at Japan, their interest rates in Japan are at 0%. You don't get any interest if you borrow money to the Japanese government. And that is because, so look, a 10-year government bond in Japan is only paying 0.73%, but a Canadian 10-year government bond, okay, is paying you at the same time 4%. Huge difference in interest rates. So why is Japan not paying any interest? Because Japan has had a low inflation problem for over 30 years, and they're trying to keep interest rates low to generate inflation. Why would they do that? Well, just think about it. If you've got a credit card, mortgage, car loans, student debt payments, if the interest rates are low on these payments, you have more money to spend, and they're trying to stimulate the economy to grow. But like I showed you over here on this spreadsheet, guys, if you look at the history of the Canadian dollar against the Japanese yen, you can see that as the Canadian dollar interest rates, if interest rates in Canada are going up, it strengthens the Canadian dollar against the Japanese yen. And we can have a look just over here on this spreadsheet for our history. Look at the difference. You can see the blue line and the orange line, they literally move together. Soon as interest rates go higher in Canada, the Canadian dollar strengthens against the Japanese yen. Soon as interest rates go lower in Canada relative to Japan, because remember, Japan has not been raising interest rates for a very long time, you can see the Canadian dollar will weaken against the Japanese yen. And look, you've had this huge trend where interest rates in Canada have gone from paying a 0.5% premium over Japan to now paying nearly 4% premium over Japan. And that's why the exchange rate has been going higher. And you can see this has been trending higher for a very, very long time. When you're looking at the exchange rate, the CAD against the JPY, look, it's really been happening since 2020. For nearly 3 years now, you see this long-term trend, okay? So what that means is, clearly, if you're an investor, where would you park your money? If you're a Japanese investor, you'd rather put your money in Canadian government bonds than Japanese government bonds because you can get more interest paid to you as an investor. And on top of that, the oil price is pushing up the value of the Canadian dollar. Now, you've got some analysts predicting that oil is going to go to $100 a barrel. Okay. And if it does, all it's going to do is continue to strengthen we're going to continue to strengthen the Canadian dollar against the Japanese yen. So that's another trade that we're in at this moment in time. Okay. So these are trades. Okay. I can show you the members' results. Here's Alab, who sent me his results yesterday. He made £475 profit from taking that trade, which I showed you, the pound against the US dollar. So members always share with me their results. This member, look, same trades, £150. This member, £293. This member made £582 profit. This member made £5,183 profit. That's fucking ridiculous. I'm actually going to reply to him because I didn't even reply to Sean and say, well done. Okay. So look, the proof's in the pudding, guys. How much people are making, okay? £50. This man made £441, £332. Okay, look, guys, you can see the results speak for themselves. Okay, so members are taking these same trades. Look, CAD JPY, pound USD. Okay, so look, we're sending these trades to the members. They're doing really well. These are the fundamental reasons. Okay, so when you're getting on trades in the markets, guys, you have to understand, like, where are interest rates going? Where is inflation? What are central banks doing? Where are interest rates going? This is all the stuff that I teach on my online advanced courses on my website. So if you ever want to become an independent trader and see these trades for yourself, all the knowledge is there for you guys. Or if you want to come and join the VIP members and trade alongside me and all the other members from all around the world, you can. Okay, I just want to explain to you guys exactly what is going on currently in the markets. All right, guys. So thank you for watching. If you're not part of the trading team, come get involved in a 30-day trial. Come and trade alongside us. If you want to learn how to invest for yourself, come and take one of the online video courses on my website. Okay, come get in touch. My team will give you information. If not, I hope this video added value. Okay, this is going to go up on my YouTube channel so you can re-watch this for your education. All right, guys, and we've got another live streamed webinar coming up shortly.